The inflation problem is not going away. Producer inflation came in much hotter than anticipated, on the back of weaker than anticipated retail sales and diminishing consumer sentiment. A strong labour market and the upcoming FOMC meeting minutes released late next week could provide a lot of turbulence. Are we at the start of a sell-off? Let's run the numbers and find out. There's a lot of euphoria inside the markets at the current time. With US producer prices increasing way more than forecast, the Fed is unlikely to cut rates anytime soon. Artificial intelligence, or AI, is a major growth factor. AI's adoption throughout the whole entire globe is going to change everything, and is likely to drive the markets higher. But is AI enough? Stronger than anticipated inflation data caused this initial spike in the VIX. When the VIX spikes, the major indices come down. One thing that we've noticed, even though the PPI came out, it didn't spike the markets up that traumatically. Well, it did for a while, with the dollar and yields both going up since retracing. But we do see something, and it's not a very good sign. We've seen the VIX come down, but also the major indice, in terms of the Nasdaq, it closed down. This means that traders and investors are expecting a retracement in the major indices. Just before we go into yields and bonds and gold, we'll have a look at the other futures. When looking at the S&P 500 futures, we can note that it's sold down. What about the Nasdaq futures? That's what we were looking at just before. We can see the weakness in the Nasdaq. Don't forget, the Nasdaq is the best barometer of stocks that have AI exposure. What happened with the Dow? More industrial by nature. It too sold down. What about the Russell 2000? It sold down as well. We can therefore see weakness inside the major indices and the potential for the VIX to keep on spiking up. This is a very important thing to keep your eye on. Keep your eye on the VIX. We noticed also, because of the stronger than anticipated inflation data, the yields have been coming up, as too has the DXY, the US dollar currency index. This increase in yields has put a lot of negative price momentum on bond prices. We can see that the DXY, in combination with yields improving, has placed negative price momentum on gold. If yields keep on improving, if the DXY keeps on rallying up, and we would anticipate that if the VIX spikes, beware of commodities and bond prices, and also the stock market. It will be hit. This is why it's so incredibly important to know how different charts intercorrelate with each other. All the different charts moving in different directions tells us something about the economic system. As oil increases in price, this puts cost-push inflation into the economic system. That means everything ends up costing more. That is transported. Therefore, when we see oil going up like this, it is by nature inflationary. Turning to the crypto market, which is a great barometer of risk-on or risk-off behavior, we can see Bitcoin has been consolidating for a couple of days. I've also overlaid gold's price momentum here so you can compare Bitcoin and gold to each other. As Bitcoin moves, so too does the entire crypto market. To understand if the Bitcoin rally is starting to weaken, we can look at the alts. When we see negative divergence from Bitcoin's directional price momentum, that means weakness. This doesn't mean that you should sell everything or anything like that. If you know your structural levels, you can buy on weakness because you know where the smart money is going to come in and support price or going to go out of the market and dump. Thinking about intercorrelation and interdependence, if the yields start to spike up, and as does the dollar and the VIX, expect Bitcoin to retrace. There's a lot of positive momentum inside Bitcoin and the crypto market at the moment, but don't let that con you. There is nothing that can escape the stock market's gravity. If the stock market decides to tank or retrace severely, it's going to retrace everything, eventually. At the moment, we can see some weaknesses emerging inside Solana. Solana is a very powerful project. You can see how it was following Bitcoin's gravitational pull, except it's starting to weaken. This is very likely with top-performing alts. They needed a lot of momentum to keep their prices where they are, or increasing. We can also see with AVAX something very, very similar. We can therefore say Solana and AVAX are throwing a bit of a warning signal. And what do we see with XRP? XRP is following Bitcoin's gravitational movement. You can see it didn't follow it that severely, but it's starting to weaken. What about BNB? It's very much like XRP's action. You can see that initial push up in Bitcoin. That certainly added some fuel to the fire in both XRP and Binance Coin, but it was nothing like what happened with Solana. Solana really feels it first, as does AVAX. The biggest mistake that people tend to make is they only focus on the chart that they're putting money into. For example, if you're only putting money into XRP, you're not going to really look at Solana, or you're not going to look at AVAX, and you may not even look at Bitcoin to understand those intercorrelations and interdependencies. But it's vitally important to cast a wider view. You cannot ignore the main markets as well, so keep your eyes on the major indices. In the last 24 hours, we've seen 128.54 million in liquidations. The majority of those liquidations have been long liquidations. And as far as liquidations concern across positions, 57,506. As the main markets have closed, it's good to keep a bit of an eye on how these liquidations are changing throughout the weekend. Apple is an incredibly valuable company, and we must understand Apple's momentum. If Apple weakens and then starts selling off, expect the market to follow it. So let's zoom in and see what's cooking with Apple. One thing that we noticed, the volume has been decreasing inside Apple for some time. I wanted to also show you just a little bit of analysis when we look at the 200-day EMA, or exponential moving average. The only other time that we've seen kind of recent action like this, price coming down and spearing the 200 EMA, then recovering, then coming back, was in this period here. Now what I've done, I've just done a bit of an analysis on that because I want to show you potentially what could happen inside the markets. You can see the last time this happened, we got a very big rally up and then it started coming down. I'm not assuming that this could happen, but just be aware that's what a lot of people will be posting on social media. What becomes important now is understanding the objective dynamic market structure that underpins Apple. Apple has been trading for more than a couple of years. It's been trading for literally over 15,660 days. So therefore, we're not just going to go back and look at this and say, oh, that's the way the market will go. We can't do that. We need to look at structure, specifically CTKS structure. Specifically, I'm going to zoom into this area here and look at how that fractal might play out. If that fractal does play out, we would expect a little bit more negative price momentum before being flipped to the positive side. But does structure actually support this case? To answer that question, we need to zoom in and have a look where the structure is in this specific area. Let's throw on the indicator. Now, what do we see here? We're seeing a tremendous amount of structural support inside the market from about 178 to 179. This could definitely result in Apple's price coming down and finding structural support and then being rebounded. This is a distinct possibility. You'll find the vast majority of people look at moving averages, exponential or simple, and that's really important to gain a perspective of where other people are looking. In this community, on this channel, we look at objective dynamic market structure, or CTKS structure. The reason that we do this is because it accounts for all of price history, not just 200 days or 100 days or 50 or less, all of it. But it does so with a very specific scientific methodology to produce the most statistically significant support and resistance levels in existence. A lot of people would say if this 200 period moving average gets taken out, there's nothing below it. But that's not the truth. There is substantial structural support inside this level, and there's a little bit more down here as well. If Apple bounces, we would expect the entire market to bounce. Turning our attention to the US 10-year yield, and this is very important to look at yields. As the yields spike up, it can cause all sorts of issues. And you'll notice this. What we have here is the federal funds rate and US interest rates. The US interest rate is this blue line. The federal funds rate is this other line. We can see that currently we are above. The federal funds rate is above on a log scale this interest rate. And this is important to bear in mind. You can see the Fed has held interest rates higher for longer during other periods, such as from around 2006. And it's held it higher for longer at other periods of time as well. We have very limited case references in terms of this higher for longer stance. In this case, in the years 2000, we had higher for longer as the markets came down and eventually moved into recession. We had higher for longer around that 2008, and that was a nasty time. The GFC just came and pummeled so many people. And we had higher for longer in around the 2020 mark, and we saw what happened there just before COVID. Now we're seeing higher for longer at the current period. A lot of people want the interest rates, the federal funds rate, to start to come down and interest rates to start to come down. But every time this happens, the markets actually tend to melt down. Personally, I don't want them to come down. I want them to stay at a plateau for as long as we can get it. Because yes, there will be volatility in the market. And that's what I've been pointing to for 2024. But if AI takes over and it rewrites the world as it could potentially do, the markets will go higher. An industrial revolution, a new one, doesn't come along every day or every decade, so just be aware that this is putting the markets through enormous turbulence. As an investor and a trader, one is for time in the market, the other timing the market. Both are important. You need to know how the majority of people are looking at a specific chart. If you throw all the EMAs on, you can see that the US 10-year yield is being very well supported. This is another factor where the street will say, we're getting to a position where we've got increasing momentum and we expect the yields to go much, much higher. If this is the case, expect the DXY to go higher as well. This will put equities, commodities, and crypto under pressure, under stress. If you remember back to Silicon Valley Bank, what happened as the rates came up? Supposedly, Silicon Valley Bank didn't manage its risk exposure and therefore went bust because of interest rate differentials. We've seen some stress in the regional banking sector. We could see more and more stress and more bank failures if the interest rates go higher, for exactly the same reasons as we saw with Silicon Valley Bank. Increasing yields is also a problem for consumers, and you can understand that from a very easy perspective. When the amount of debt servicing starts small and then just grows more and more and more, and the capability of people to repay that debt becomes less and less and less, the disposable income inside the economic system starts to retrace. As it retraces, consumer discretionary spending starts to decrease. The amount of available funds to do things also starts to decrease. Interest rates on not only mortgages but credit cards, they go up, and as they're going up and disposable income is coming down, there's less funding the consumption component of GDP. That will translate into the GDP falling over time. Therefore, looking into the structural levels of the US 10-year is important, as the structural levels on the US 2-year yield are important as well. Before, I showed you what the increasing VIX did to the Nasdaq. Now we're going to see what the increasing VIX did to the US 2-year yield. I've just gone into the 2-hour basis to give you a bit more granularity. One of the things that we see when the VIX spiked up, it brought the 10-year, the 2-year, and the DXY with it. They like to hang out. They're a group of mates. And what we see just currently is that the VIX is decreasing at the moment. But we can see a little bit of a discontinuity here because the 10-year is increasing. This is all about the idea that deeper inflation will mean rates are higher for longer. What I've done is, instead of turning on the indicator, I've banded these areas together to show you where the high impact areas are. We just breached two very high impact areas, but we couldn't get past this third one. That meant if we can't go back, we're going into the one below, and you saw quite a bit of weakness, but we've been steadily grinding our way through all of this resistance and seeking to convert it into support. If that happens, please keep an alert on 3300, this particular level here. It's going to be vitally important because there's a bit of a fresh air gap above this, and we haven't seen one of those inside the US 10-year for a while. In fact, all of these levels are very, very strong. If the US 10-year gets above that 433 level, it's potentially going to fly. When you consider that the major futures sold off, I'm not surprised because they're anticipating that the US 10-year will breach the 433 level. When looking at Bitcoin, one of the things that we can see, all the moving averages are very supportive of price increasing. But is the structure? The structure is the key level. One thing that we know, the Nasdaq futures have sold down and sold into the close. The S&P 500, the Dow, the Russell, they all sold down. Is this going to indicate that we're going to see a little bit of weakness in Bitcoin, perhaps retesting these lower levels? And if so, where? That's why we use CTKS structure to answer those questions. Structural areas are vitally important to understand. We've seen recently that there was an enormous amount of one structural resistance, and Bitcoin blasted through it. It took a little bit of time to do and a lot of ETF money, but we're very happy it did. And when you're inside the crypto market, make sure that you're investing and you're trading. One of the things that we see right here and right now is at around a little over 50,600. There is a degree of structural support there. If prices come down, we would expect these areas to activate. That is quite strong structural support. If it goes down a little bit lower, that would be fine. One of the interesting things, when you look at moving averages, a lot of people would be saying, it's going to come down to here. There's actually a big problem with that. That's in what's called a negative fresh air gap, where price could move down very quickly between just under 50,000 all the way back to 46.5. So it's very important to know where the structural levels are. And of course, when price gains momentum, it goes in one direction. But if it gains momentum, negative momentum, it can overshoot these levels. So that's important to be able to pin where these areas are. We look at Apple because it's indicating a degree of structural weakness in its current price momentum. But if we look at something like Nvidia, it's showing a lot of positive price momentum. One thing to just bear in mind, if we get a retracement and then we get a push up, this would be very healthy, because generally what you find is that you get a bit of a fake out before another breakout. Just keep that one in mind. A lot of people want a very simple answer. Where are the markets going? It's very straightforward. They're going to either a structural level above or a structural level below. And that depends on how the tier 1, 2, and 3 charts all align. If you don't know how these charts are aligning, you just basically enter the market with a lot of blindness. Everything is intercorrelated and interconnected. What happened with the yields, what happens with the DXY impacts everything. The good news is that we're in the weekend, so Bitcoin can go in whatever direction it wants. If people are going to start taking profits because they're getting worried about the main market, we would anticipate coming down to these levels around the $50,000 mark. If we're expecting upside, keep your eye on the 53,600 level and also around that 55,800 level. And then, of course, there are some positive fresh air gaps in between these different levels. Bitcoin is undoubtedly going much, much higher. The question is when. And it's always better to buy at a discount rather than at a premium. You want to buy like a consumer. That is, if your latest consumer thing that you want to get, perhaps it's an iPhone or an Nvidia chip. If you want to buy that, you want to buy it at a discount. But inside the stock market, inside commodities, inside financial markets, everybody wants to buy the most expensive thing and sell it when it goes on a discount. Turning to XRP, when we pop the exponential daily moving averages on, we can see that XRP's price is just below the 200 EMA. This is not exactly where we want to be, but the concept is, what is structure telling us? These particular shaded areas are called SCs or Stanfield zones. They're accumulations of SLs or Stanfield levels. The SLs are indicated through the indicator. I've just drawn these SCs for you here to give you a better appreciation of where the price could go. The 5600 to the 5633 mark is a very big area of structural resistance. It's very unfortunate that XRP has fallen below that price. It's seeking to retest it at the moment. We can see a negative fresh air gap and another one. This could be very problematic for XRP, especially if we find that in the Monday session, the VIX, the DXY, and the yields start to spike. If you're a trader, this volatility is magnificent. If you're an investor, it gives you a very good opportunity to dollar cost average in more effectively. From a structural support level, just keep your eye on this 54.94 mark. That's going to be very important for XRP to hold that. From a structural perspective, if we manage to get through this particular area of resistance, the next major one is from 57.28 to 57.41. Keep your eyes on that. Please let me know in the comments, where do you think the main markets are headed? What about commodities and what about crypto? Have a great day or night ahead, my friends, and Kate and I look forward to catching up with you again in the next video. Bye for now.